Advanced Financial Accounting. In this presentation, we're going to work a practice problem related to a consolidation. So we have two separate companies that we're going to report using a consolidation worksheet in a consolidated format. We're going to have company P that's going to be the parent company. Company S is going to be the subsidiary. We're going to say that P is carrying the investment in S using the equity method. P has a 100% interest in S. And when the purchase took place, it was purchased for the net asset price. Get ready to account with Advanced Financial Accounting. Note that as we go through these consolidation problems, we're going to basically be adding levels of complexity as we go. So there's going to be a lot of variations we can have here. And so we want to start with a fairly basic scenario and then add levels of complexity so we can concentrate on those different type of things that are going to add levels of complexity rather than just throwing in a big lump sum of problems and not knowing how to address any one of them. We want to isolate kind of scientifically so we can see what the differences will be and what those different problems will do. So here, then, we're going to have a consolidation where P is purchasing 100% of S, not a controlling interest, not over 51%, 100%. That's going to be one thing that'll make it a bit easier for us. We also note that when the purchase took place, P purchased S for the value of the net asset price at that point in time. In other words, if you look at S's balance sheet, assets minus liabilities, the book value, the equity section, we're going to say that the purchase took place for that value. And that's going to make the first problem here a bit simplified too. We're also going to say that the purchase took place at the beginning of the year. And it's also the first year that we're talking about here. So the purchase took place on January 1st of the current year. So we have an entire year where the whole thing was these two companies were together or had a controlling interest, where P had a controlling interest, 100% interest in S. And now it's the end of the year, and we're going to take those two separate books and consolidate them together. Note also, we're going to be saying that P, the purchasing company, is going to be using the equity method to account for S. In other words, you'll recall when we think about the methods, if you're over 20%, you've got influence. Obviously here they have a controlling influence. They're over the 51%. But how should P be recording on their separate books before we consolidate the investment in S? Well, they have some different options. They could put it on their cost possibly, but the equity method seems like the most appropriate method to be using. And that's what we're going to start off with. So we're going to say P is carrying the investment in S at the equity method or using the equity method. And now we're going to consider that in the consolidation process. All right, so we're going to have the information is going to be on the left-hand side. And then we're going to go through our consolidation worksheet on the right-hand side. So we're going to say that P purchases S common stock for $315,000. So $315,000 was for the purchase, and that happened at the beginning of the year. At the beginning of this year, we're going to do the consolidation worksheet at the end of this year, and then the net assets at the point of purchase happened to be the exact same amount. So the purchase price happened to be for the exact market, the book value. The book value of S was what the purchase took place for as of the beginning of the year, and it's now the end of the year. So P uses the equity method to account for investment, make a consolidated financial statement worksheet. So that means that P has on the books this investment account right here, this $353,000. How did that get there? Because if we consolidate these together, we're going to have to get rid of that. We can't have a consolidation thing being showing that there's an asset that basically represents ownership in yourself. So we're going to have to remove that. To know how to do that, it's useful to know how they accounted for this. They accounted for this using the equity method. All right, then we got the purchase at the beginning of the year. So the purchase took place at the beginning of the year. We're consolidating now at the end of the year. So first thing to consider is, okay, this is going to be the books over here for P and S. We're going to say that we're going to take their trial balances. What we would do is say, okay, give me your trial balance. If we're the accountant, we're going to say for P, and give me the trial balance for S. And then we're going to line them up side by side and match them up as best we can. That's going to be the first thing that we'll think about doing. And then we'll just say, hey, look, I'm just going to sum them together, and that'll give us our consolidated financials. It's not that simple for a couple different reasons. One, you got these accounts you're going to have to eliminate, which includes this account here and includes the income account down below. And two, also note in practice, then it's not going to line up this nicely. So if there is a situation where you have a parent subsidiary situation, especially if you're making the subsidiary from scratch, you want to make sure that you make the two GL accounts very similar in nature. So the groupings of the accounts are very similar. For example, in the expenses, it's going to be most different oftentimes, right? You're going to use different names to say the same things, like auto expense versus vehicle expense, different account number, different names for different expense accounts that you're going to have to then go in and line up if the two chart of accounts weren't created from the same model. So if you were to create the S corporation from scratch, like P was to break out the S corporation, then you would do your best to use the same template for the two items so that when you consolidate them, it will be easy. If P was to purchase S, however, then S is going to have a completely different template for their chart of accounts. You could still consolidate them, but you're going to spend a lot of time looking through the chart of accounts and saying, all right, which expense accounts can I combine to which expense accounts? That'll be kind of a problem. Here, not a problem. It's a book problem. So that makes it less of a problem. It's a book problem, but it's less of a problem to do that kind of combination or consolidation process. We have them lined up very nicely. So the accounts line up together here, so that looks good. And then we're going to add them up. That's going to be one of the methods that we will take a look at. And then we're going to have to do the adjusting entries. So if we were to do that, it would look like this. So we're just going to sum them up. So here it is. P's books, there's S's books, here's our total. All we did was sum up the two columns, the 136 plus the 77, 213. The 184,000 plus the 78,000, 262,000. The 215 plus the 93, 308. So now we have a trial balance that's on a consolidated format. However, we have some accounts, like we say, this account is a problem here. And we see that this account down here is a problem. So we're going to have to do consolidation or elimination entries. Now, to think about those consolidation or elimination entries, it's useful to think about, okay, how did this investment get on the books in the first place? How did that happen? Well, when they first did the purchase, they purchased it here for the investment of the 315 in cash. We're going to say this is the first journal entry. This is our equity method. So we're not going to try to spend a lot of time in the equity method. We did a presentation on that, but the equity method would have been, all right, they debit 315 cash. This is the first year of operations, they credit cash, they debit the investments. This is company P. And then what happened is they reported the investment in S, the 73,000, and the income. Why? Because S had net income of 73,000. That's revenue minus expenses. 73,000 of net income and P under the equity method owns 100%. Therefore, they debited the investment by the 73,000 and credited income 73,000. So those two numbers you could see kind of match up there. And then you could see that what happened is they gave a dividend. So here's the dividend that S gave, meaning they gave dividends to the owners. Who's the owner of S now? 100% owner P. Therefore, that 35,000 went directly to P. So P then said that the cash went up and they credited the investment by the 35,000. So that means that if you took the first year, and this is the end of the first year, we had equity method on P's books increased the 315, increased by the 73, decreased by the 35. That's how you get to that 353. So that 353 that we see on the books for P, that makes sense now. So we're saying, okay, there's the 353. Also note that considering kind of the simplified format that we had here, considering the simplified format being that they purchased it for the exact book value of S at the beginning of the current year, and they own 100% of S, that means that we can also just say, well, whatever S's total equity should be represented by this investment in S. In other words, if I was to take all the blue accounts over here for S, the 220,000 plus the 95,000 minus the 35,000, and then I got to take the income too, which I can just take the 73,000, or I can take this minus this. So I'm going to say plus the revenue, 266,000 minus the expenses, the 128,000 minus the 45,000 minus the 20,000. That equals the 353. So that's the 353 here. So in other words, if you take all of the equity, if you take all of this for S, because P owns 100% of it, and when they purchased it, they happened to purchase it for the book value as of the beginning of the year for S, this number ties out. And that's why we're kind of starting out that way. So the equity here in S is being represented in one line item in P. So that's going to be the idea. All right, so given those facts, that we have this total now we have this total and we can then post our elimination entries. So the elimination entries, we're going to start off with what we know. This is kind of our total. We can think about this kind of setup as being similar to an adjusting worksheet at the end of the time period, like an adjusting entries. We're going to have a similar kind of worksheet there, but these are going to be the consolidation or elimination entries. Now, unlike the adjusting entries, we're not going to have to enter these into the books of either P or S. These entries are not going to go into the books of either P or S. They're simply for the consolidation process, because these accounts that we are eliminating are correct. If you were to say, look at P's books individually, they recorded the 356 correctly if you report it individually. And so what we want to do then is just record these for the consolidation. So first we know that I'm just going to go down these. I'm not going to record this entry debits first and then credits. I'm going to record it in the way that makes most sense to me. Why would I do that? Because it's easiest to format that way. And then two, it's also easiest for someone to look at. You might say, well, it's prettier if the debits are on top. But really, I mean, if I go back to this thing 5 years from now, I'm not trying to find something that's pretty. I'm going to have to figure it out again. And I want it to make it make sense, right? So this is the way my mind is working to make it make sense. And that's how I would put together your working papers and whatnot, how it makes sense to you so that you can go back and figure it out. So we're going to say that the investment in S is going to have to go down. Why? Because we have the investment in S here. If that's in the total column, I can't, and this represents the entity as if it were one entity, which is the point of the consolidation. I can't have an investment in myself as an asset here. So that needs to be eliminated, that's for sure. So the other side of that, as we saw, notice the other side of this transaction, because this investment represents all of the blue accounts here. So, but also note, you can think about it this way. This investment equals the beginning blue accounts. This would be the equity as of the beginning of the year. And then this credit, the income, represents the portion that is income down here, the total income on S's books. So what I'm going to do is I'm going to eliminate all of these, the common stock, the retained earnings, and the dividends. Those just need to go away. So here's the $220,000 for S's common stock. It needs to go away because that common stock is completely owned by P. P owns all that common stock. It's not issued outside of the consolidated entity. Therefore, it needs to go away. So we're going to debit it to make it go away. It's a credit here. We're going to debit it to make it go away. So what's that look like? Well, we have common stock for P, 488. Common stock for S, 220. That adds up to the 708. And then we're going to remove, on the eliminating entry, S's portion, the 220, bringing us back down to what P had, the 488. So we're leaving it what P had. Same with the retained earnings, right? This retained earnings represents really the retained earnings at the beginning of the year, because we didn't record anything to retained earnings during the year. What's going to happen is the net income is going to roll into it in terms of the balance sheet. And note that the dividends here, we broke out. So in practice, you might have these two things combined. In other words, you might look at the GL for retained earnings and see that they paid out dividends out of retained earnings of the $35,000. Here we broke out the dividends so that you can see them in a separate account. Therefore, this retained earnings is the same retained earnings that was there at the beginning of the year. There's been no activity recorded to it. All that's going to happen is the net income and dividends will roll into it as of the beginning of next year. So considering the purchase happened for the book value as of the beginning of the year, we're going to eliminate the entire retained earnings. The retained earnings are going to go away because it's the first year of operations. And that retained earnings represents the beginning retained earnings that happened at the purchase point, where the purchase took place for the book value, the net assets as of the beginning of the year. And so we're going to eliminate the entire retained earnings. So there's the $95,000. So we're going to say, all right, so retained earnings for P was $383, $95,000 for S, total $478. Then we're going to remove S's portion, we're going to eliminate S's portion, bringing us back to the $383,000. Then we're going to do the same thing for the dividends. So dividends is a debit here. What are dividends? Dividends are part of the retained earnings that was taken out, part of the earnings. So we can say the earnings in the current year were $73,000 plus the 95 or whatever, but we'll say the $73,000 in the current year, and they paid out $35,000 in dividends to the owners. Who's the owner of S? 100% owned by P. So we can't have the consolidation can't include dividends that went to ourselves. So that's an intercompany transaction. So we're going to say that 35,000 on S's books is a debit. We need to do the opposite thing to it to remove it, to make it go down. We're going to credit it. So we're going to say, all right, so now we've got the dividends, the 116 plus the 35,000, that's the 151. We're removing S's portion, the 35,000, to get us back down to basically P's portion of dividends. That the P's dividends actually went to people outside of the organization. S's dividends all went to P. P's dividends went to the stockholders of P, which S is not among. S is not among the stockholders of P. Okay, so then we're going to say then that the income from S also needs to go down. So remember that we said this whole portion down here, this whole portion, like all of the blue accounts, if I was to add up all the blue accounts, that would add up to the 353,000 up top in the investment. So we've accounted for the equity portion. Now, what about the net income? The 266 minus the expenses, that's 73,000. So these then add up to 73,000 represented net income. That's not a loss. That's debits minus credits, revenue of 73,000. How do we account for that? Well, we're not gonna eliminate all these accounts. What we're going to do is eliminate what P represented as income from S. So that 73,000 is right there. That 73,000 represents the net income from S that's double reported. Why? Because P recorded it as one line item on their financials using the equity method. We don't want it represented as one line item. When we consolidate it, we want these to be represented in terms of all line items, revenue minus expenses. Therefore, we're not going to be eliminating this time S's revenue or income statement, revenue and expenses. We're going to eliminate the one line item that P reported representing their net, revenue, net income of S on their books. So we're going to say, okay, now we're going to remove the 73,000. So that means that we've got P represented 73,000 from S. S doesn't have anything there, of course, and that means that there's the 73,000 removed. That has now gone to 0. So then that's going to be the main journal entry you gotta keep in mind. Now there's one other kind of quirky thing we're going to have in our first problem here, and that's going to be the relationship between the property, plant, and equipment, so depreciable assets. At the point of consolidation, when we consolidate these entities, what we want to do is represent the depreciable assets at the book value. In other words, we want to take, at the point of consolidation, we want to take S's property, plant, and equipment and net it out against the accumulated depreciation and report it at the book value there, and not record accumulated depreciation, but record just the assets at that point in time at the book value. Now note, because this is the first year of operations, the consolidation took place at the beginning of the year, then we can kind of back into what the accumulated depreciation is. In other words, S is just going to continue on depreciating their property, plant, and equipment as they normally would, but we want to record the book value of it at the point in time of consolidation. We can kind of back into that number by saying, all right, well, it's the first year of operations. They got 40,000 here in accumulated depreciation, and they depreciated in the current year 20,000. So 40,000 minus 20,000 means that they must have had accumulated depreciation as of the beginning of the year of 20,000. So I'm going to record the journal entry and then explain it, because I think that makes a little bit more sense. So we're going to say we're going to debit the accumulated depreciation, which will look like this. That's going to be decreasing the accumulated depreciation because it's a contra asset account. And we're going to be crediting the building and equipment. So the building and equipment then is going down as well. So you'll note that the net between these two is there's no change. If I pull out the trusty calculator here, the giant trusty calculator, we're going to say then that, let's make this a little smaller, that before we did that transaction, we had the consolidation, which was the 912, let's not type in here. We had the 912,000 minus the 476,000, and that didn't work. Let's do that again. We've got the 912,000 minus, and then we're going to say the 476,000. That's going to be the 436 And then afterwards, we've got the 892,000 minus the 456,000. And that one, once again, should be the 436, which I believe is the same number there. Why do we need to do this then? Because as of the beginning of the year, we're trying to record the books in terms of the consolidation as of the book value in the machinery and equipment. So we want to, as of the beginning of the year, we'd like the accumulated depreciation to be netted out as of the beginning of the year, and then just record the depreciation as of the current year. So for S's books then, in other words, we're trying to say as of the point of consolidation, as of the beginning of the year, we're not going to have an accumulated depreciation account. We're just going to record the item on the books at the net value, which is lower by 20%, instead of having the amount on the books minus the 20,000. Then we're going to depreciate from that point forward. So it's kind of like at the point of consolidation, we're going to say kind of like a purchase took place at that point in time, right? So it's on the books now with no accumulated depreciation, but at kind of like the purchase price at that point, and then we're going to depreciate it going forward. So that takes a little bit of time to kind of understand, and that's a little bit tricky the way a book question could ask it this way and say, hey, it's the first year of operations. You got to back into what the accumulated depreciation was because you happen to know that this is the first year of operations. In practice, you would obviously know what the accumulated depreciation was because you would have done the transaction. So you would probably just look at the transaction and say, okay, what was the book value as of that point in time, and net that out. So, but in a book problem, they could ask you something like this, and if they did, you're say, well, how would I know what it was as of the beginning of the year? And it just so happened that this is the first year of operations. If it weren't the first year of operations, you wouldn't be able to kind of back into it the way you did here. So, just a little different. That obviously book problems might do that a little bit more just to kind of test your knowledge to be able to work into, kind of back into some numbers when necessary, just for good practice or good understanding of how all this stuff fits together. Now we're just pulling in the other numbers here. So now we started with something that was in balance. We're ending with something that's in balance. This was the net income that was consolidated before. It's been changed now by that 73,000 because we've eliminated the 73,000 income that was kind of double reported, right? It was reported here on P, and it was reported here with all the income accounts on S. So we eliminated that item, and we eliminated the investment. We eliminated the other side of that, which was basically the equity section, and then we made that adjustment for the building and equipment, the property, plants, and equipment, and related accumulated depreciation. Now, the consolidated worksheet is something that we can then generate our consolidated financial statements with.